The best investments are generally ones where everyone else thinks you're wrong, right? So we had this company where everyone believed it was the most creditworthy company in the world. It was as good as the federal government, AAA rated. And actually the federal government today is not even AAA rated. It's like AA plus or something. And we bet that a company with a AAA rating was going to go bankrupt, and we made 35, 40 times our money. The inverse of that is in November of 2008, a shopping mall company called General Growth, second largest shopping mall company in the country. The stock went from $63 a share to 34 cents in like 6 months. And the reason why the stock went down 99.5% was they had a lot of debt. They borrowed money in the CMBS market, which is the securitized real estate market. And that market shut down during the financial crisis. And everyone said they're going to go bankrupt because they can't pay off their debts as they come due. They had $27 billion of debt, about $15 billion coming due in the next 18 months. And the stock went from like a $6 billion market cap to a $100 million market cap. And my bet was, the malls had gone from 93% occupancy in 2007 to 95% occupancy in 2008. So the occupancies were up, the rents were up, the net operating income was up. The fundamentals of the company were solid. And these were basically Class A's or the fanciest, best malls. And so the assets were fine. And before this company, everyone who had invested in a company that had gone bankrupt, the shareholders had lost all their money. But I didn't understand why that had to be the case. I read, a book on bankruptcy. I called our lawyers. I'm like, look, I think the assets are worth more than the liabilities. Why shouldn't the shareholders be able to make a meaningful recovery? And they said, look, it can happen, but it never does. Because what happens when a company gets delisted and goes bankrupt is people sell the stock, distressed investors buy the debt at a discount, and then they work the process through the courts and end up keeping 100% of the company. So I said, well, we're going to do something different. We bought 25% of the company in the market for $60 million, starting at 34 cents a share. I joined the board, and then I helped the board run a process that benefited not just the creditors, but also the shareholders. And the stock went from 34 cents to ultimately $31 a share. But it was, so again, the most contrarian investment you can make buying something is to buy stock in a company going bankrupt, right? Because everyone says it has to go to zero. And if you do a little bit of work, a lot of work, and have an insight, those are the best examples.
You've absolutely changed your style over the years. You used to be an aggressive activist.
I'm always aggressive.
Always aggressive.
Why not be aggressive? Is everyone here aggressive? I assume you're aggressive. You go to this place. You want to be aggressive. You're either aggressive or you're weak. Which do you prefer?
You don't publicly short companies anymore.
We don't short stocks. Big mistake, don't short stocks.
And you've achieved a measure of permanent capital in the last few years, which is very important to Pershing Square.
Yes.
How has that changed your risk tolerance? How has that changed your risk parameters?
So I would say our risk parameters haven't changed, but what's changed is when I first went into this business, no one knew who we were. And we were telling kind of big public companies that we had a better way for them to run their business or structure their business than they did. And the idea was, how could someone outside of McDonald's or Wendy's, some of our early investments, have a better insight to how our company should be run or structured if you don't even work here? And so the early days of shareholder activism, companies really pushed back on shareholders who had ideas. But we had some big early successes. Shareholders did really well. You build what I call reputational equity over time. When I started Pershing, I was 37. Today, I'm 58. I'm basically the age of most. I'm sort of one person removed from, or one or two people removed from every CEO in America. I've been on many public boards, built a reputation. People can kind of check me out by talking to CEOs that we work with. And the advice they give is, you should hear what he has to say. And so we haven't had to barge our way into the boardroom. Today we get invited in, and we can do what we do without having to run a proxy contest. So that's what's changed. It's not really a change in risk, it's a change in sort of the maturation of the firm.